On today's show, how understanding tax harvesting losses and capital gains can improve your practice. Part 4 of this week's series on tax investment strategies with nationally recognized columnist Ken Davis, CLU, CHFC, CFP, and CPA. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and INSMARC. Let's get down to business. Well, welcome to day 4, Ken.
Hey, Stephen.
Well, we're talking about harvesting, and this is stuff we should be talking about in December, but we're in tax time. People are awake to the tax issues. I love that H&R Block ad that's out there. You're leaving billions behind. Your pile is on every seat in the stadium. I'm sure you've seen it. I want to talk a little bit about this from a consumer point of view. When we talk about a fund cost or a fund taxation, or we're talking about the charge by the RIA, whatever these charges are, a lot of people, we're always talking in basis points. I've noticed that when we say this, there's just a little humor here. I look at a fund and I say, the fund cost all in, including the fund cost, the statement of information, and the AUM charge by the RIA, notice all our acronyms in our industry, is about 3.5. Now, when I say 3.5%, it doesn't sound that bad. It's still expensive. Don't get me wrong.
No,
that's expensive.
To you and I as advisors, it sounds bad,
right.
But to the average consumer, probably not.
But the moment I convert the 3.5 to 350 basis points, everybody goes, why does 350 basis points sound much more punitive than 3.5%? And it does.
It's a bigger number.
But it's the same.
Yeah, it's the exact same result.
What if, now Ken, I'm just letting you fantasize here as a tax, you're a CPA, you're you're a CFP, CLU, CHFC. If I went ahead and I took all my costs, my AUM costs, my statement of information off my fund, if I took my fund charge, I took all that and I add that up, and then I start adding, and it's a taxable, it could be capital gain, it could be ordinary income, depends on how long it's held, whatever, or a little bit of both. And I converted my tax bracket, instead of saying I'm in the 22% effective, we had to do a lot of iterations to get to that statement, remember, because we don't even know what half the time it is.
Right.
If I converted that into an actual basis point, if you're in the 25% tax bracket and you were saying my AUM charge, my statement information, and my fund cost is 350 basis points, and I said, yeah, and in your 25% ordinary income tax bracket, if it was ordinary, if the charge was ordinary, you'd be doing 2,500 basis points in taxation. If I wanted to keep the balance sheet clean and put both sides of the argument on here, I think I'd convert everything to basis points, because I think it would exacerbate our argument about tax advantage products.
Well, that's interesting, because so many articles in the financial journals and Forbes and whoever focus on the costs of management. The tax costs are much greater, and when you start comparing a 25% tax cost versus a 3.5% or 2,500 basis points versus 350, you're exactly right. And it may be by changing the verbiage, we're waking people up to the fact that taxes are important. Personally, when I looked at my own career path as a financial planner, there's really two things that taxes that affect the end result of our clients, and that is taxes, trying to control taxes and trying to control risk makes a huge difference.
Sure. When I'm looking at the total expense load, and this is why we're saying we're always managing, and there is that, I think at least our industry is at least that part. We're talking about the statement of information, finally, the fee there. We're talking about the fund cost.
You brought up before the statement of additional information and what those costs really are trading costs. And it's interesting. It's not required to be given to the client. Rarely does anybody ever look at it. When you do look at it, you don't get a nice little chart with a summary what the total is. It's so much cost for this, so much for cost for that, and it's all buried in all of this language. You really have to dig it out, and that's why a lot of people don't talk about it.
Well, I love tax harvesting, because what we're doing is, the reason I'm converting my tax brackets into basis points is just to keep everything on the on the balance sheet equal to each other. I'm trying to give some kind of semblance of what the real cost is.
Well, let's talk about what tax harvesting is, because we've used that term a lot. I'm not sure we really defined it. And what tax harvesting is basically saying, let's say I'm managing my own portfolio, and I've got 50 different stocks in my portfolio, and some of them are in a gain position, some are in a loss position, and I'm trying to evaluate my portfolio first for performance and secondly for taxes. Well, the performance is these ones that aren't doing so well, maybe I should shed them and get rid of them and invest in something with more upside potential. Well, I create a capital loss and I'm only allowed to deduct on long-term capital loss basis $3,000 a year against ordinary income. So, but I can use those dollar for dollar against capital gain. Okay, so I've got these losses. I want to rework my portfolio. So during the year, it's like, yeah, I want to get out of this and into this, and I'm creating these losses. Well, it also means that you might have some positions that have done really nicely, but you think that they're pretty much done. They've already gained all the gain they're going to have.
It's time to take a little profit off the top.
Yeah, they're starting to get overpriced. It's time to liquidate those, get off. So then you can look at your losses, compare them to your gains, and wash them together and essentially reduce your taxation. Be careful. You have to understand the rules of you first take short-term capital gains against short-term capital losses, long-term capital gains against long-term capital losses.
Like to like. And
then you net all those out. And don't just listen to what I said. You actually have to look at the rules and figure that out, or work with your advisor. Or actually run it through one of those software packages where you actually put in the assets and pretend like you're doing a pro forma tax return and see what the result is.
We come back from the break. We're going to continue this discussion on tax harvesting at the end of the year. It can really help you do that job. Some people say, why do that if you're in tax advantage products? Well, again, we'll talk about that tomorrow. We'll be right back after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to the second segment. Ken, we just described some of the things. Again, remember, most of the time we're talking about financial services industry, the way they talk about funds and so forth. We're talking about fee drag. We're talking about the fund drag. There's expenses in it. Now we're really focusing this whole week on tax drag. Now, let's go back. I want to make sure that we got this because you have to match up like to like taxation. So walk us through the harvest issue here because it's an important one. And why do we want to bring this up? Because this has impact on how you discuss annuities, how you discuss annuities with LTC riders, and how you discuss life insurance, TAMRA, or actually a full MEC, which we're going to talk about tomorrow.
Well, basically, Schedule D is a great place. Go look at Schedule D and look at the instructions if you want to get some sort of concept of how these calculations are made instead of reading books about it, because it'll walk you through the calculations. There'll be the short-term, calculation, the long-term calculation, and then the net. And the way it does is it first does the short-term section. It's short-term capital gains are reduced by short-term capital losses. Okay, and you come up with a net number. Losses.
Now, is that ordinary income then on short-term capital gain?
Well, I was just going to explain that. If it's short-term capital gain and that's all you have, then yes, that's ordinary income. If your short-term capital losses exceed your short-term capital gains, then you have a net short-term capital loss.
Is there any limit to that?
You really don't get to deduct that per se. You
can only wash what you have.
Right. So then you look at long-term capital gain and long-term capital loss, and you collapse those down, and it's either a gain or a loss. If it's a loss, if you have a total overall net loss, then you can deduct up to $3,000 on your tax return.
On capital gain loss.
Capital gain losses each year. If it's, of course, a long-term capital gain, you get a reduced tax rate. So your losses really aren't all that valuable. $3,000. But first you have to net the short-term and the long-term, and then net the two of those. And so you have to go through the calculation to see what the impact of it is. So don't just assume that you know what the result is going to be. You actually have to run it through this process.
I'm surprised because I looked through some of our clients who have already filed, well, actually, they're actually the year before, so they're 2012's filings. And we said, here's what we could have done for you if you were our client at the time this occurred, because they're fairly new clients. We could have done some tax harvesting here, and here's the number. We did kind of, I would call it kind of doing some CSI accounting. We're kind of actually going to the morgue of 2 years ago's taxes, and we're actually exhuming their 2012 1040 to see what we could have done. When we show this to a client, they're amazed at these numbers. And by the way, that gets us talking about the next year's planning. But it also gets us talking about alternative tax advantage products, which is why we're doing this show. Because once you understand what Ken's talking about, this can be a huge, huge adjunct to your practice.
You know, it just popped into my head. I've never really thought about tax harvesting as it relates to variable annuities, but you and I both discovered a number of years ago that a loss on a variable annuity from the sale is actually an ordinary loss that can be offset against ordinary income without limit. There is no $3,000 limit because it's not a capital loss. It is an ordinary loss.
Non-qualified.
Non-qualified. And then I even got to thinking further. If you're going to do a diversified strategy of some long-term, large cap, small cap, whatever, you could actually buy different variable annuities in each of those segments and wait for that particular segment to be in a loss position while the other ones are gains, and you could sell that off and start creating ordinary losses. So you could do a whole different kind of tax harvesting, which I've never seen done before, and it just kind of popped into my head. So.
Well, I really like that idea to bring that up, because I think when we first discovered this years back, it was revolutionary. Now we're using this as a tactical plan. Once you understand harvesting at this level, whether it's VA or any of the other things we're talking about, mutual funds, EFTs, all non-qualified, of course, what we're talking about now. When you're looking at this, to understand this concept and practice using a basic tax like TurboTax or something like just practicing as an advisor, you're going to see the impact of this, and you'll be able to discuss with your client. This is why we're bringing it up. Here's why we're bringing it up, because I want you to look at the numbers. We can do some proactive tax planning for next year, and we want to introduce you to the inventory of tax advantage products, which might be able to mitigate a lot of this. And I love the idea, if you said yesterday's show, where there's certain funds that actually look at that tax issue and specifically build their structure around not only returns, but also to make the minimum amount of taxable events.
Yeah, I mean, there's a lot that can be done. The ETFs are nice because they don't turn the portfolio. They're kind of a static modeling kind of thing. Lots of people buy into the asset allocation model using indexing types of funds. It keeps your turnover low, your 1099s low, and gives you some control. Or if you do individual stocks and bonds, you can do that with the tax harvesting yourself. And of course, there's the managed mutual funds where if it's in an IRA or qualified plan, you don't care. If it's non-qualified, be careful of the managed open-ended funds you're buying, and if there's a whole lot of deferred taxes sitting there that could be, triggered in a downturn like 2008, just be aware of all those things. And taxes are a really important part of it. I mean, for instance, I ran numbers in 401k installations. If I assumed a 10% gross return versus a 7, at the end of like 21 years, that 3% differential on compounding meant that the tax-deferred accounts were about twice what the after-tax accounts were.
It's an issue, and that's why we want to always compare these tax issues, which we're now saying has now become a major player in the way we do advising. Well, that's all the time we have today for today's show. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. And don't forget, you can view all our past episodes on downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. Ken and I will see you tomorrow.